Aditya, let's talk about what we are seeing here in the broader economy, because we are getting some conflicting signals just about the slowdown in jobs, especially when you look at the latest July numbers versus maybe what we're seeing in the continuing claims. So talk to me about whether or not we are seeing that weakness and ultimately what that tells us about the chances and risk here of recession.
Good morning. Thank you for having me. So obviously, as you said, the risk after the July jobs report, the concern was that we were headed for a hard landing. We maintain the view that the labor market's normalizing, we're not heading into a recession, and that the July data were somewhat idiosyncratic. The recent decline in jobless claims, it's not just 1 week, it's the last couple of weeks. That's been very encouraging, right? That's been consistent with our view. And then that goes hand in hand with solid retail sales today, because remember, it's a little bit chicken and egg between the labor market and the consumer. So what you really want to see is both of them doing well hand in hand. That's what we saw this morning, and that's why equity markets said, you know what, the Fed might cut less, but good news is good news. So we're happy about these data.
Aditya, is there anything underneath the hood in some of the data that you're looking at that could indicate still some cracks in the consumer?
Right, so things are slowing down. We grew at 4% last year. That was never sustainable, so it was inevitable. So 4% in the second half of last year, that wasn't sustainable, right? So the question is, are we now headed back towards kind of trend-like 2% growth? That's very much what the latest data look like, rather than a harder landing. And we're not really seeing that hard landing in consumer spending. Retail sales were a little bit soft earlier this year, but then the last 3 months they've bounced really nicely. Services are holding up. Yes, there's some concern about, discretionary services losing some steam. But again, I would view that as normalization, because you had this big acceleration in discretionary services as kind of the last leg of reopening post-COVID demand. That was bound to fade. So our broad view is that, yes, you'll have ups and downs in the data. Certain sectors might look soft for a few periods, but things look solid and very trend-like right now.
So Aditya, what does this all tell us about the chances of a rate cut next month, the size that we're going to get, and then ultimately looking past the September meeting, what we'll likely see between now and year end?
Right, so we are of the view that the data flow, both on inflation, which was just a little bit stickier than the Fed would like, in housing, as well as activity, labor market, all of that suggests that the Fed can cut, and it will cut in September, in our view, by 25 basis points. But there isn't a need right now for supersized cuts or accelerated cuts, namely once per meeting. Now, obviously, if inflation were to cool off significantly, if the labor market were to weaken further, the next step, the more dovish step relative to what we're expecting, is that they cut every meeting rather than every quarter. So 25 in September, 25 in November, 25 in December. But that's not our base case for now. Our base case is 25 per quarter going forward, at least through the end of next year.